And it could be Bank of Japan fears. I want to express that a little bit differently, which means Bank of Japan had a big announcement, right? So we definitely have the formal announcement Valentine's Day of their new head. And there are folks that are definitely saying, hey, he's a dub, don't worry about it. And the dollar yen has really done nothing today, which is a good thing for some stability. It's very much kind of intonating this sideways churn at this monthly level, and we'll have to see what the week brings. But if we do close above, you can see how it taps above. If we do close above 132.5 on the weekly, we're not there yet. Popping above is not the same thing as closing above on a weekly. Then we definitely can take a run, right? At least take a run right back up into this 135. It still would not correct the trend. The trend is definitely still down. Next time we break this 131.25, you know what's going to happen next. We're gonna pop right down into the 200 pretty quickly, but we're not there yet. So we're sideways on this news. In the meantime, I still think this is going to be a challenge for markets. Why? Because the whole point of getting in kind of new leadership is to, traders are betting that he will, his new cabinet, whatever regime, will abolish the yield curve control, right? Not under Kuroda's watch. And there's a lot of indecision about this, or I should say not indecision. They're not sharing the roadmap, but it matters to markets. So global investors do need to worry about this, okay? Because if they do indeed remove the cap on yields, there are estimated $2 trillion of bonds that they could sell. And you know that the yen, you've heard the arguments, hopefully, from Craig and myself, that the yen is moving home, right? So you see the stimulus that Japan is doing. You see the stimulus that China is doing. But they're doing it, and a lot of it's going to stay in country. How much of that liquidity is really going to move abroad? Let me show you another chart. For example, liquidity matters, right? Here's an example. We've got Bank of Japan did a massive amount of yen intervention September 22nd, October 21st, again the 24th, and that's it. Started moving higher, had a little bit of a dip in December, and then here we are. So this is basically Bank of Japan assets and its liquidity, and China did the same thing around the same time. We've talked about that convergence of central bank intervention. And then you can see what happened with the markets, right? So here's kind of a line showing you, okay, but it's diminishing rate of returns and how much of it is making it to outside trade and such. There's a lot of kind of keeping it both currency and economic activity growth via stimulus in country. So anyway, the point is watching that very carefully, because this is really, really also an enemy to bonds. So right now, we do not have a shift, in portfolio at all. In other words, in Japan, but it could flow from overseas to domestic debt. That's all I'm trying to say, and that's the core of the issue. Dollar yen, however, take a look at the government bonds. The 10-year government bond is percolating above 0.5. So at some point, they better come back in and kind of tap that down, or it's going to move higher. Makes sense? So here's the dollar yen right here. That's a big move right here. Okay. And now it's gone sideways. But that to me looks bullish.